Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets. And is often the case, we have an FOMC minutes release, and we record on Wednesday afternoons for that very reason.
Yeah, it's almost like we planned that.
Yeah.
It's almost like about a year into our show, we said we need to start recording on Wednesday afternoons instead of Wednesday mornings so we don't have to re-record things.
There you go. Yeah, hot off the press.
Exactly.
Even though this is actually being released on Thursday, November 2nd, we're recording on Wednesday, November 1st, and Jerome Powell just put my mind at ease because he assured me that the U.S. banking system is sound and resilient.
Excellent. That's going to be Golden Rule Radio for this week. Everything's fine.
Despite the spike in interest rates, I mean, all the news this week, including jobs reports, so we've got payroll, we've got obviously the FOMC minutes, we've got geopolitical tensions, but the inflation numbers coming out worse than expected. Inflation's climbing again, not shrinking. And quite honestly, the only reason they didn't hike their lending rates again is, I think, social and political pressure. It's just too sensitive right now to be adding insult to injury when you've got a slowing economy, even though they say the growth is better than expected. The GDP expanded at 4.9%, and that's nominal value. To me, it's painting an ugly picture. Life is getting less and less affordable, and even McDonald's meals now are costing what it costs to go have a sit-down meal with a tip. Life's just getting expensive.
Yeah, Tori, it's a good point. And, you know, Rob and I last week pulled up a chart I hadn't looked at in a while, and it was kind of comparing government spending year to year. I'm still flabbergasted at the amount of money that was spent this year compared to, say, 2008 when the stock market crashed, or 2020 when we had a massive increase in spending due to COVID. Somehow in 2023, we seem to have decided this was the year to really run the federal credit cards ad infinitum. So, yeah, seeing that increase in spending and the expectation going forward. I know Kevin and Dave have been talking a lot about spending going forward over the next couple of years, and the amount of money we're expecting to see added to the national debt over the next number of years is just staggering.
It's been staggering, and there's no end in sight. And you feel it, I feel it, we all can relate to it. I mean, Halloween candy last night, up 13% year over year. There's kind of a real indication of inflation rate. So that's the expense of life. And unfortunately, the Fed admits there's, quote, a long way to go on inflation, unquote. So they're acknowledging that. It's just that they can't do that. And the reason, well, one of the primary reasons they're giving for not doing it is the strength of the jobs market. Well, the job market is, honestly, Miles, you're seeing wage suppression. So it's not that. But Chairman Powell even points to immigration being so strong that it's a resurgent immigration type of activity that is exceeding now the pre-pandemic levels. Well, no kidding. We just crossed the 10 million illegal immigrant threshold since Biden took office. 10 million illegal crossings since he took office. That's a lot of people in the workforce.
Right.
A lot of them are obviously of working age. So they're trying to slow the job markets, control inflation, reduce spending, tighten the credit markets, tighten the Federal Reserve balance sheet, but yet you have this boost in population and working class looking for jobs. And unfortunately, what that does is it drives wages down. So life gets more expensive, wages shrink, you're not making as much. You don't hear them talking about minimum wage increases at all anymore. That's politically taboo. And so they're really caught between a rock and a hard place here on raising rates, controlling inflation versus suppressing the economy, not being able to employ people, job market being too strong. Really a fascinating time to be watching from the sidelines.
Yeah, trying to balance all of those factors. I wouldn't want that job. And especially now, you know, you brought up a second ago some of the both political as well as just societal or social pressures as far as interest rates go. It's Halloween yesterday. It's Thanksgiving in a couple weeks. It's Christmas a month after that. This isn't the season that the average American is going to respond positively to increased cost of living expenses. So what are the odds we even see an interest rate rise before the end of the year? And before you answer that, how is that going to affect us going into an election year next year where they're not going to want to do it next year either?
Well, the more they raise, if there's a political tie, and what they're being accused of is being politically biased. Now, whether that's true or not, I don't know. Is Jerome Powell sensitive to the Biden administration's needs? Janet Yellen, as a Treasury Secretary, certainly is. I mean, there are ways that she can control government finances as well, directly and indirectly. And that's one of the theories, is that next year, in an election cycle year, you can do some very favorable things for the incumbent. So that has yet to play out. I can't imagine raising rates between now and the end of the year for the reasons that you give, and for just the cost of living and the stagnation of the housing market, both residential housing market, but also commercial real estate and investment real estate. So that's dragging slowly, and if not to a stop. So you're right. I mean, that's kind of the key thing. And really, the Fed lending rate isn't what matters. It's the interest rate markets are set by the bond markets.
Right.
The bond markets are king bond. And Japan, you guys mentioned it on the show last week, how they're trying to control their yield curves with having the Bank of Japan, their central bank, step up and offer to buy all these government bonds. Well, here we are a week later, and it's proving to have zero effect. And now they're scrambling, trying to redefine. Now they're redefining their 1% promise to buy an unlimited amount of Japanese government bonds at a fixed rate of 1% to bolster the markets and drive the yields down. No effect. Now they're saying, oh, that was just a loose upper bound kind of definition rather than a rigid cap. And that's because the yen now is cratering against the euro,
right.
15-year low against the euro. So all that to be said, these are the underlying turmoils in the market, and all pointing to, in part, why we've seen gold climb. So let's transition to the gold charts here. What's been going on in another exciting week?
Sure. Well, gold's been climbing. You're correct. We've seen gold now go from the very low 1800s, where, and we've talked about this over the last couple of weeks, gold got real close to breaking into a lower low, a legitimate lower low position, and didn't. And then what we've seen since then is we had this declining range in gold, which we had a breakout, and then what I like to see a retest. So we kind of put our foot on top of the breakout zone, which is a declining channel. And since then, we've continued up from about the low 1900s. So we had about a $100 move in the range, and then we've had about $100 since then. Sounds like two really strong steps forward, and I think there's a good argument for that when you look at the charts. The last bit of growth we had, that last $100 or so that we went up to, we broke 2000. We got to about 2008, maybe 2010 intraday. And I think there's a very good chance we might be on the way back down. We took our 2 steps forward. We're going to take 1 step back. And you know me, I love when things all line up at the same time. So we break into the top end zone, you know, the all-time high zone, which starts at about 1980 and ends at about 2080. We've been playing around the lower end of that. We've been both above and below it. We've done it with divergence against things like RSI and MACD. That's where you see indicators going the opposite direction of price. So in this case, gold is going up, the RSI is going down. So we've seen some divergence against the trend there, which usually signals a bit of a sell-off is pending. And lo and behold, you line your fibs up, and by the time we get back down to a nice, healthy, say, 618 correction, that's going to put gold and that top end of that range and that 618 fib all right around 1890, give or take a few bucks. So again, I understand this is crystal ball stuff, but I also know that there are a lot of people out there who trade markets based on technical analysis. So when you get a number of people together who all kind of adhere to a different thought process on how they view technicals and how they get their entrance and exit points into the market, and you say all of these different groups of people are probably going to be making a decision around this area, that's where I start to get excited. So gold is going to do one of 2 things, and I know you hate when I do this, but gold's going to do one of 2 things. We're probably either going to park here for another week or 2 and then start climbing again, because the other way you can shake some of these divergent activities out of a market is to just kind of park your car and wait. because they tend to be based on averages over time. So you just need to move that kind of calendar forward a little bit. So that would end up cleaning it out. What generally is more likely is you get sort of a sell-off for a period of time, which will cause the gold price to inch back down 2 steps forward, 1 step back. We started at 1810. We finished at 2010. Maybe we get down to 1900. 1890, something like that. So I think gold over this fall, and well, I guess now we're stepping into winter, and I do think there's some legitimacy to the argument that seasonally, especially here in the United States, November, December are not investment months. They're spending months for most Americans. So I wouldn't be surprised to see gold actually slipping here, aside with what's going on around the world. And where I could be wrong there is the fact that the rest of the world doesn't really care about American Christmas and Western European Christmas as much as we do. So I could be wrong, but we'll see.
No, I mean, it would make sense. And stepping back, I mean, I think you would say that that has nothing to do with reversing the trend of this secular bull market that we're in.
Yeah, emphasis correction, not trend.
There you go.
Yeah.
Okay. So that is not to discourage the listener that is holding gold. In fact, it should encourage the listener, because everything that's an undercurrent, right, and an underlying fundamental that impacts the precious metals prices seems to be ramping up and building to where it points to me to a very strong 2024. So you all should be hoping for Miles to be right, that we do see this pause. We do see a 50% retracement from a $200 climb, come down $100. And honestly, that'll be just barely below or right near the 200-day moving average anyway. So you'll have some moving average alignment there. A few weeks ago, when this thing had gotten so oversold and undervalued, we were about 6% below that moving average on that dip to that 1809. And now we're 3% above the moving average in that 11% climb. Gold went up 11% from trough to peak. So absolutely, it should pull back. The only X factor that has been the X factor is the geopolitical strains. We can't predict how much this conflict ends up gathering steam and expanding and becoming larger than what it currently is. And we're not going to dive into that deeply here today, but just keep your ears on the news and listen and find the real stuff, because we have an absolutely incredible amount of U.S., NATO, and UN naval assets now currently in the Mediterranean that doesn't speak to a normal, quickly subsiding conflict. So I do have concerns there. What about silver?
Sure. So silver, very similar to gold, just lower numbers. We still haven't seen, and I brought this up last week, so maybe I'll stick that chart up again, comparing gold to silver. Silver is still within that trading range where gold is broken above it. But as far as the action goes, like what has silver done over the last few weeks compared to gold, it's very, very similar. We had a rise, we've got RSI divergence, we've had a correction back, bouncing between kind of the top and the 382 fib. You know, if we see a decline in silver, you're probably looking maybe somewhere, not too much, 22, a little under 22 on the spot price would be about equivalent move down in silver as to me looking at like 1890, 1900 on gold. That'd be about the same type of percentage move down. So silver and gold looking very similar, just at least on the short term. Gold continues to outperform silver. That's why I still like silver. That has to change eventually. It might be 3 years from now. Like we said that in 2008. It was 2011 when it finally happened.
Well, what's gold? About 4% from its all-time high?
Yeah.
And silver is about 115% from its all-time high.
It's got a ways to go.
So it's got, we're not even close.
So the catch-up will be totally worth it, I promise. Whenever it happens, don't ask me when that's going to be.
When do you think that's going to be?
Don't care. Moving on to the next chart. I don't want to be pessimistic about silver. You need that one guy in the lineup who either hits home runs or strikes out. You don't want a whole team of that guy, but it's nice to have one of those guys in your lineup. And for me, that's silver. Silver either hits that walk-off home run to win the game or goes back and sits down. And right now it's just been sitting down, and that's okay. Now we've seen inklings of it. With, say, Silver American Eagles or the premiums on junk silver 6 months ago. We've seen inklings of it bounce up and down. It's wanted, it's desired, it just hasn't caught on that mainstream yet to really push it. And that's why I'm still buying it. So moving over to the equities market, I'll just keep rambling. I'll let you jump in between since we're doing charts. Moving over to the equities market, I ran most of the equities charts last week. I'm just going to use the Dow here this week to prove a point because this is on the opposite end. We talked about gold seeing some divergence on the upside, probably looking at a correction back down. I'm going to argue the Dow is probably going to do the same. The Dow has given us some pretty strong lower lows. I'm very pessimistic on the equities market right now, both fundamentally and from a chart perspective. Yeah, let's say we see a bounce in the Dow 34.5. Something like that. We were at 35.6 not too long ago, all the way down to 32.4. So it's been a pretty significant decline in the Dow just since August. And the August high got nowhere near the all-time highs. So I'm very pessimistic on the equities market right now. And I think the rest of America is as well.
Oh, for sure. And if it weren't for the Magnificent Seven, I think we'd be seeing some of that already. But keep in mind, too, I was talking to David McElvaney about this, and one of the underlying issues that you have with the equities and why you don't see a massive decline all the time is 401ks and pension plans and, these regular monthly purchases from a payroll and employee standpoint really can help bolster the market. It's kind of a new day and age. But all that to be said, there will still at some point be a massive sell-off. And man, it's been top heavy. Yeah, it's up 221 today in response to the Fed announcement, but that's just nothing. 0.7% in a downward trend to me is not boding well.
And finally, the dollar, with not positive or negative news on the dollar from Jay Powell this week. A dollar obviously sitting stagnant. So next couple months, with at least at this table, our expected, let's call it a pause on the raising interest rates, I wouldn't be surprised to see the dollar kind of flatline here, probably trickle down a little bit, but I wouldn't expect anything dramatic unless some political event causes it to be dramatic. A minute ago, I was thinking while I was talking here, I have this sort of assumed feeling that as we're moving into an election year, the government's going to do everything they can to keep things as calm as possible. So I'm thinking back here while I'm looking at the gold charts going, let's see, what other election years have we had where the government has been successful keeping things incredibly calm? Well, how'd 2020 go?
Not very well.
How about 2008? How about Y2K? How about 1992? Like I'm thinking back to
1987.
I guess the election was 88, so that would have been the year before. Yeah. So we're not in this country great at forcing calmness among the American population when we need them to focus on voting for whatever particular person we want them to vote for. So I think next year is going to be a bit of a mess.
Yeah, I'm with you. And in the meantime, we can buy the dips, add to ounces, certainly diversify your portfolio. That's critically important. Spread things around and just be prudent and a good steward and hopeful. Keep your eyes and ears open. And hopefully this show is helping you do just that.
So that's going to do it this week for Golden Rule Radio. As always, we appreciate you stopping by. If you liked what you heard, YouTube buttons are right there for you. Better yet, give us a buzz. We're happy to talk with you about your personal precious metals portfolio. You can give us a call at 800-525-9556. You can also find us on Facebook at McElvaney Financial. We're on Twitter at ICA Gold, and our website is McElvaney.com. Thanks for listening. Have a great week.